GMGM, welcome to another Touchgrass podcast episode. If you've been following the show for the past 2 months, you've been noticing we've been getting a lot of investors on the show. This is after Tom's famous post about the fundraising cycles of crypto changing and whatnot. And we've had a lot of investors on to talk about, this in particular. We have Wyatt from Castle Island Ventures today. Suraj from the Monad team actually helped connect us. Suraj, obviously a close friend of the show. Wyatt, welcome to the show.
Yeah, Roger, thanks for having me. And thanks to Raj again for making the connection.
Awesome. Why I think we there's a lot to talk about. I'm gonna pick your brains on how fundraising has changed over the years, but I think just sort of set context for everyone listening in. Can you give us a brief intro on yourself and maybe about Castle Island Ventures, and then we can sort of set foundation.
Yeah, definitely. Happy to touch on that. So personally, I got into the crypto industry around 2021, towards DeFi summer. I was working on the hedge fund side previously, covering software and fintech. Uh, Crypto started to enter my purview of my fintech job, or the time I spent covering that category. And pretty quickly, I wanted to spend all my time in the industry, and can touch more on why that was and what that looked like. But just got really excited about capital formation on chain, about non-sovereign money. And so they'd gone into crypto venture and joined Castle Island in mid 2023. So coming up on 3 years here. And Castle Island, we got started in 2018 by Matt and Nick, who are founding partners. They'd previously built out a lot of the digital assets team at Fidelity. So that's our background, and that's informed what we do today, which is to invest in financial market infrastructure supporting blockchains. And again, can touch more on what that looks like specifically, but to this day, we continue to focus on that.
Yeah, that makes sense. And just for our audience, can you mention like what type of stage you guys come into and like what's your
Yeah.
typical size?
Yeah, so we are mostly seed and Series A, and can do pre-seed as well. Typical investment size is 2 to 20 million. So the seed stage, that's more in the $2 to $5 million range, and then Series A more in the $5 to $20 million range. And we typically will lead or co-lead probably more than half the deals that we're in. So oftentimes we'll be leading or co-lead, but we can follow as well.
Yeah, that makes a lot of sense. And then, since you've been there since 2023, that's like three crypto decades. If
Yeah.
you think, with each year being a decade. I think let's start this off with, obviously since your partners have a background in Fidelity, I'm assuming the way that you guys do due diligence is extremely different from other funds in the space that probably don't do that much due diligence. Can you talk a little bit about how you've sort of seen a shift in like this current cycle where I would assume partners that have experience in like the traditional world of finance have a bigger edge because they understand the nitty gritty of what's going on in Web 2.5. How has investing changed since like 2023 to 2025 to now?
Yeah, definitely. The first thing I'd touch on is the landscape of what crypto businesses look like from then to now has changed a lot. And the best example of that I probably have is that in 2023, one of the major pushbacks that we would get as a firm to our strategy was why we would even do equity investing in crypto and whether there would be exits. There wasn't a huge history of M&A that had happened previously to crypto companies. I think Bison Trails was the largest one at the time, which I want to say depends on how you value the Coinbase stock, which is moving around, but a $400 million acquisition. So people were skeptical, and based on all of the multi-billion-dollar token outcomes that you were seeing or maybe thought you were seeing, people didn't really see a ton of value in investing in equity-based businesses for crypto at that time. But it was something that we were pretty convicted in. So historically, about 80 to 90% of what we've invested in has been equity businesses, and the other 20% is on the token side. And I'd say since 2023, as you've probably seen too, a lot of the investors that are still around in the crypto landscape have shifted a lot from venture token investing to venture equity investing. So that's just been one major shift. What's been interesting is I think even at that time, people weren't sure how to underwrite protocols from a venture perspective. And I candidly don't think a lot of those questions ever got answered. It's just more like the ecosystem just moved away from venture token investing, and maybe that'll come back. But that's the biggest one. And then I think relatedly, we've seen just categoric interest change a lot. So it felt like crypto venture was almost just DeFi and then maybe NFTs and marketplaces. If you go back to like 2021, 2022, And you had centralized exchanges and trading infrastructure, which are the kinds of things that we've historically focused on. But if you looked at all the dollars going to crypto venture, that wasn't the majority of them. And fast forward to this day, it's a lot more, as you've seen in stable coins, in trading infrastructure, perps, obviously, category that's seen a lot of adoption. And with that, I think you do just get more traditional underwriting methods. Like I don't think these businesses are fundamentally different than a subset of businesses that you have in traditional finance. So you can look at a Robinhood or other trading-based businesses, which can be good comps for exchanges, whether they're centralized or decentralized. But the biggest change is just probably that we've shifted from over 75% of crypto venture dollars going into token-based projects before 2023 to now over 75% going into equity-based today, which is a huge shift.
Yeah, and I would say like that also changes. I would assume that changes how VCs think about horizons
Definitely.
in fund cycles. Like, was that sort of unorthodox for crypto VCs at the time when back in 2023 when you guys were doing this, and now it's sort of become a norm? Would you say?
Yeah, I think people saw the opportunity for quick liquidity, and I think people like to vilify venture funds for doing that. I understand, especially LPs are starving for liquidity these days. Like it's very difficult for funds to make distributions generally. So if there was an opportunity set there, I understand why people were pursuing it. But I think it became fairly clear that a lot of these tokens weren't going to hold up to the valuations they were launching at over the course of a 3 or 4 year vesting period. And at the same time, if you're harvesting over that period, then in comparison to a high growth traditional equity startup, your timelines are actually not that different. That the startup might stay private for 10 years, but they'll probably be growing very well in that timeline if it's a successful one, especially in this day and age where, again, we can get into this, but I think the pace of growth of companies has accelerated so much because of technological advancements and AI. And you see teams just accomplish so much so quickly. So I think that people have to change their frame of reference on time to liquidity, even though it was a little bit of a fallacy at that point. Because yes, the token's going public right away, but you're not seeing anything meaningful for at least 24 months. So it feels that way. But realistically, I think if you look at the funds that do well, they're not going to harvest on that different a timeline, even if they're doing equity now compared to tokens then.
That makes sense. And then for projects listening in that want to pitch to you, would you say them structuring the deal for an equity heavy sort of investment is preferred? Like, would you always say no to a token based deal, or is that sort of a preference for you
No,
guys?
we're open and would still continue to invest in token based businesses. We keep that 80-20 split pretty consistent. Our philosophy on this is typically we are expecting a company to be a token based business or to be an equity based business, and we're not sitting on the middle and saying this one could go either way that much. There are occasions where that can make sense, but for us, most of the time, we're saying, okay, this is a token, this is an equity business. The form factor for a lot of those token businesses will be a safe plus token warrant because I think it's an effective structuring methodology, but we're not expecting value to accrue on the equity side of that. And we're definitely not expecting value to accrue on both sides. Like maybe they end up pivoting and it becomes an equity business, but we are not sitting in the middle and saying, oh, maybe it's a token or maybe it's an equity. Even though I think that there are some folks who look at it that way.
That makes sense. And then, why just sort of double down? You've been at the fund since 2023. The fund's been going on since 2018. I want to pivot the conversation away a little from like investing philosophies to more like wins.
Okay.
Are there like any ongoing investment bets that you're monitoring closely that you'd like to highlight? Like these are some portcos that are doing extremely well right now. And then we can sort of deep dive into a lot more. It's like sort of fun thesis. I want to understand like what verticals you're excited about.
Yeah.
And the best thing to sort of talk about first is like the investments you're excited about right now.
Yeah, we became very excited and vocal about the stablecoin industry around 2020, 2021, and have made some investments there that have grown a lot. We continue to be very excited about. So one is called ARC, formerly known as Dollar App. they're building a neobank in Latin America powered by stablecoins for mostly mass affluent users. And then there's another company called Felix, which does US to Mexico remittances, but they're expanding into being also a broader neobank, but that in that case facing Latin Americans in the US. And we're incredibly excited about those companies and several others that are maybe a little bit earlier in the growth cycle, but we have done incredible things already. And we want to continue to invest in the stablecoin space, to be clear about that. So if anyone listening that's building there, we'd love to chat and learn more and explore where we can work together. That's one that comes to mind. And I'd say from a timeline perspective, we've seen that category continue to grow, but probably isn't anywhere near the end of its life cycle. Like, we think there's still a lot of room left there, and very, very excited about it. We are seeing, call it, the next generation needs in stablecoin infrastructure. So something like a stablecoin clearinghouse is a clear need, where you need to be able to settle stablecoins across chains, across countries and entities, and have one centralized venue or something that looks like a centralized venue that's doing settlement between these. We recently invested in a company called Valinor that's an up-and-coming private credit solution to face stablecoin and other fintech businesses with credit facilities to meet their capital needs. So that's to say that you have someone like Rain that has off-chain and on-chain needs, and you need credit for that, because essentially you're going to have a lag in liquidity from one place to another. And that's something that we're seeing at scale with a lot of these stablecoin companies. So again, we continue to be excited. We think it's still early, and both of the businesses that we backed, and hopefully for the ones that we will.
That makes sense. And then, like, one thing that I see as a common sort of question mark on CT, a lot of people think that stablecoin businesses don't have moats. Like, anyone can spin up a stablecoin, anyone can do these businesses. But from like a venture point of view, like, what is the moat? Like, is this,
Yeah.
when you look at a stablecoin business, is this more like, hey, this founder has, like regulation related connections in this country. He's from Latin America, so he's tend to do better in this country. Like, what are some of the criterias when it comes to like investing into a stablecoin business for you guys?
It could be different for B2C businesses versus B2B. I'll start with B2C. With B2C stablecoin businesses, and I'd extend that to fintech and beyond, owning the end user is really valuable, and you develop a trust relationship with your user, which I think makes it difficult to disintermediate. And I'd say Felix has this, any number of these businesses has this, because they've just come to be comfortable using your application. Their money sits there. It takes time to develop trust with the place where your money's moving. So I don't think you can just build a clone and disintermediate that. And I think it also allows them to tap in. The most valuable thing they built is that audience. They can tap into that audience and cross-sell other offerings or bring in other integrations. So I think, unlike, a middleware software tool, there's a trust aspect that's valuable there. I think that's increasingly true in the AI era, actually, where digital trust is becoming something that we're all very concerned about. I know people have family members who've been scammed digitally over recent times. So if you're comfortable with the product and have a trust relationship, you're good. It's going to be sticky. On the B2B front, I think network effects for a lot of these stablecoin businesses really matter. If you're a clearinghouse, for example, then the number of parties that you have integrated and the amount of liquidity you have flowing through that is going to dictate the staying power that you have in market, would be my argument. Versus if you don't cross a threshold or cross a chasm there, then someone else could probably come into market and do it. I would say the same thing about some of the major trading firms. I would say a similar thing about prediction markets, where liquidity probably becomes the moat amongst above anything else. So I do think there's a moat, and a lot of it boils down to like how much of a business you've built so far, and then how much trust you gain from who your customers are.
And I would say that's probably like similar for like DeFi protocols as well. Like, if you're
Yeah,
building a lending market, it's sort of the end thing. And I think one thing that people talk about a lot these days is with AI, you have
yeah,
the opportunity to sort of go after customers that you probably wouldn't have gone after 5 years ago, because what you can do with a smaller team is just astronomical. Like, we see so many of these teams now, infra teams now building front ends, trying to build their own applications. I want to ask you, like, what has AI changed the way that venture funds think about what a company's potential is? Like, if you look at an infra player right now, do you think about the future possibilities of them owning the entire stack more proactively at the start? Has AI changed anything for you in terms of deal evaluation?
I think it's changed a few things on the dynamics of how we and I think other venture firms invest. One is innovation happens really quickly. So I think that if you're a new company coming to market, you just generally have to do things faster than you had to probably 5 or 10 years ago. Um, Both because the market landscape moves so quickly. So you don't want to become obsolete if it takes 3 years to ship something that then becomes a Claude feature. The other part is, to my point on, you have network effects or trust, which can build a moat. When you're in the stage before that, if you don't build fast enough, then someone else can say that's a great idea and start building it. And if they can get to network effects before you, then you have a bit of the first mover, first loser kind of dynamic. Um, so that's one thing I think that's changed with the AI era, which creates this funny dynamic because on the one hand, people are saying small teams can ship more than they ever have been able to, which is true. But on the other hand, I think early stage teams need to be aggressive, which means ramping spending and ramping hiring because they need to get to this point of network effects before someone else comes and tries to build the same business if they think it's a good idea. So you have this dichotomy and things that are at odds, but they are sort of coexisting. And you're seeing people take both sides of that. The other dynamic that AI has added, and this is more just purely on the side of someone who's in venture, is it used to be very valuable how many interesting companies you could find by being resourceful online or by scraping LinkedIn, whatever it is like that. And I think that's becoming a little bit more commoditized. So I think it goes back to the human trust element a little bit. You need to establish a brand um, and a reputation market that people want to seek you out and work with you. So I think in a way, founders are sourcing their VCs more than VCs are sourcing their founders in a way these days. The dynamic is inverted a little bit there, which I think is great. I kind of prefer that investors are jostling to be the best partners to founders versus this dynamic of trying to find someone who other people haven't met and maybe keep it secretive because you don't want other people to see the deal. I think it encourages venture funds to try and be better partners, to my point. So yeah, in summary, I would say companies have to build fast and there's more discovery that happens between investors and companies, which is good for everyone.
I think that's really interesting. Like, I think from what I've heard from everyone else that's been raising recently, like everyone's just been saying it's insanely tough to get funds right now. Like, venture investing is dead in
Yeah.
crypto. Where's this competition actually happening? Like, where is this funding concentrating in terms of VCs having to be more proactive to win deals? Is this like the crypto landscape in general, or is it like particular verticals within the crypto space?
I think in venture broadly, and I'm reiterating something that a lot of people have talked about, but you have some of these large and attractive companies staying private for a really long time with compelling growth profiles that are getting into huge numbers but continue to last. And that sucks up a lot of the liquidity market. And to be candid, even if you have a venture firm that should be doing earlier stage deals and they reach to go into doing one of these later stage deals, if it's something that people collectively identify as a great company, they're sort of protecting themselves. Like they're not taking a lot of risk. Whereas if you bet on an early stage company, then you as the investor in your seat, when you're talking to your own team, when you're talking to your investors, you're taking on a reputational risk of like, this might work, this might not. Versus if you invest in the next round of Anthropic, maybe you'll lose money on it, but people will be like, oh, Anthropic was a great company. You know, you can defend why they did that. So I think there's a little bit of self-reputation protecting that happens. And I think it happens even more in this environment. And the reason for that is because people haven't consistently made money over the past 2-3 years because it's been a harder time for venture. So then people tend to be risk off in the way that they're deploying. So they want to be in these deals that feel surefire or they feel safe doing in the face of their LPs. Versus in something like 2021, people had made a lot of money in the 2-3 years before then. So people were feeling much more adventurous with their capital because they're confident and because they felt like they'd made money for their LPs and they'd almost earned this right to take risk. And if they are wrong, then they won't be crucified for it in the same way because they've, again, made money for their investors in the previous cycle. So there's a cyclicality around it, which is, again, maybe stating the obvious, but I don't think it's like pure cyclicality in the sense of, okay, the market's hot, the market's cold. A lot of it is behavioral in the way that investors are feeling and how secure they feel in their jobs and their ability to raise capital. And I think we're in a period right now where a lot of them don't feel that confident. And that trickles down to it being difficult for seed companies to raise money, especially when it's not a founder who's sold a business before or has a ton of pedigree where that an investor can sell that to their investors.
And then do you think that comes back to sort of, we've had investors come on the pod talk about how it's really hard for VCs to raise their next round. Like we've seen some of the really big rounds right now come out, but there are obviously there's the other side to that where some funds have not been able to raise that money. Do you think that sort of, how many of these do you think will be around? Do you think this has a part to play in sort of the whole nature of how crypto venture funds are structured right now?
How many funds will be around, you're saying?
Yeah, we've seen so many funds trying to raise, but some are not being able to raise, some are raising. We obviously have this environment where people want to pick the safer bet. But with the sort of accessibility that a lot of LPs have, they're able to get these safer bets themselves.
Yeah.
With the formation happening on chain a lot or through other methods. Is that affecting how the state of crypto venture funds will look like in the next 3 or 4 years, where we might see a decrease in the number of venture funds, in your opinion?
I think we will. I also think a lot of these crypto venture funds have raised one, probably two funds by now. And from the LP perspective, usually you'll do two funds with someone, and on the other side, a venture firm can raise two funds before it starts to be, okay, like, how are these doing? We have a little bit more truth now. And that's partly because the investors in the funds want to blend out their entry to not be a 2 or 3 year deployment period of one fund, but a 5-year deployment period of two funds. But then you get to fund 3 and 4, which, if you haven't driven a lot of return for your investors, become harder to raise. And there haven't been a lot of exits in private markets. We had them with tokens, but a lot of token exits turned out to be not very good. And then there's not a ton of M&A. There's not a ton of companies going public. So most firms, to generalize, that have raised two funds haven't shown a lot of return to their LPs after 3-4 years, whatever it is. And at the same time, institutional investors like endowments, a lot of them were overexposed to venture. In the Trump administration, there have been a couple dynamics where endowments have probably invested less in funds or deployed new capital than before. So that creates this dynamic where it's difficult to raise a fund 3 and a fund 4 for most funds. And inherently, most crypto funds are emerging funds. Like, they all got started in 2018, 2019, 2020, 2021. So it is a huge question whether they're going to be around. What we're actually seeing, which is quite interesting, and I'm curious if you'd say the same, but there are a bunch of more generalist or non-crypto specific investors who are probably more excited about crypto than a lot of the crypto investors are, because you're seeing the crypto investors focus on AI and robotics, but you're seeing folks like Andreessen who are being pretty active, and Sequoia and Ribbit who are, yes, fintech, but like crypto wasn't their main thing. They're doing a lot in crypto. They published their token report. They all want to be active in crypto. And I think it's smart for them because they're doing that at a time when a lot of these crypto native investors are playing scared, to put it in the best way I can. So I do think a lot of the crypto native firms are going to go away. I think that some of these other generalist firms, the smart ones, will pick on this opportunity to invest in good businesses at lower valuations and a scarcity of crypto native capital, whereas in 2021 you had a surplus of it, so you probably didn't want to be investing in crypto from an outside lens. And then we will probably have the other side of the cycle where you'll have a crop of new crypto firms come up, and then we'll have too much funding, as we always do at some point. And that's sort of the way that these patterns happen.
Yeah, I think that's really interesting the way that you pointed it out. And for anyone listening in, definitely go check out Ribbit's cap table. Definitely go check out how A16Z invests in crypto. My take on this is a lot of the crypto native funds that we see, their specialization is that they understood the token game. to a very high level, and they were able to
Early on or
find
more recently, you're saying?
early on. I would
Yeah.
say like in 22-ish, like in DeFi summer, basically.
Yeah.
Like they were able to pick out some winners that were like clear. Like I remember when Pancake Swap was at like cents, and then I blew
Yeah.
up, and like a lot of these VCs like extreme. They made a lot of money on this stuff, but that playbook has sort of died down now. And like a lot of the VCs that I talk to, they've been talking about how the old token model has gone away, and now there's like a new form of investing when you have to talk about more equity stuff. There's more Web 2.5 stuff. This is more like traditional fintech investing with a layer of crypto. Like the whole token game has ended. So I think it's a big shift for a lot of these VCs when they start thinking about how they want to share deal flow.
Yeah.
Historically, what we've also seen is with token deals in particular, without saying a lot, we've seen smaller sort of subset of investors invest together in a particular token. And there's obviously like these cabals that go around. So there's a lot of shifts in what's happening within the VC space, I would say. Wyatt, I think this conversation has been amazing. We're getting closer to the 30-minute mark. I do have a couple more questions that I want to
Yeah.
sort of rapid fire your way. Um, we talked about sort of the stablecoin stuff. Are there any other particular verticals that you and your team are extremely excited about right now
Yeah.
that you definitely want to see more deals on?
Yeah. Cybersecurity. And historically, we've invested in cybersecurity, but we believe we're coming into what's going to be a very active age of fraud and digital insecurity. Um, Unfortunately, it's becoming much easier for adversaries, whether they're nation state adversaries, whether they're individual hackers, to try and phish people, to orchestrate attacks on code bases. And DeFi is a problem, for example, where DeFi is built very composably, which is great from the perspective of fostering innovation, but it creates a lot of risk surface area for a lot of these protocols because they're using code from other protocols, they're partnered with other protocols, they're partnered with other vendor solutions. So if there's a problem with any of those partners, then it's a problem for the protocol that has integrated with them. And so you're only as strong as the weakest link. You're only as strong as the weakest antelope in your pack. And the ability for these hackers is going up to whatever access they have to Mythos or whatever it is, plus their own individualized ability. And so if you have any sort of vulnerable software out there that is at a standard where it can be exploited by these tools, then that's going to be a huge problem. And it won't just be a problem for the exploited protocol, whether that's Kelp DAO or whatever it is, it's going to be a problem for all those partners as well. And that's applying this to DeFi, but it's true of software. It's true of the more broader crypto or on-chain market. So we want to invest a bunch in cybersecurity. We did a deal called Project 11 in quantum security. We think there's still a lot of surface area around custody of crypto assets, around transaction monitoring, around something around chargeback technology. We've talked about this being cool if funds are stolen or sent to the wrong address. So I think there's a lot of surface area there. SIM swaps and even social engineering are things that we focus a lot on as well. So that's a big one that I think doesn't get talked about a ton. But if you look at the amount of spend that there's going to be from companies, it's going to be a large market.
And do you think that is that more like a auditing firm that started a cybersecurity offering, or is that more like a Web 2 cybersecurity firm looking into crypto? Like, what does that company look like in your mind?
I think both are very interesting, but Keone from Monad had a few posts about this on Twitter, and I thought he put it very well. There's actually a lot of work and spend happening in auditing generally, and stuff like operational security gets neglected, especially when you look at the proportion of exploits that happen that are because of operational security. Because of that, as well as our own interests, we're probably focusing a little bit more on the operational security side. But I think both are very interesting.
That makes sense. And then Monad also launched their own OPSEC initiative. They're helping
Yeah.
founders out. So go check that out if you're listening. And Wyatt, second question: are there like any portfolio darlings that you'd like to highlight? Like these are Castle Island Venture winners that we have backed from the start, and we just love talking about.
Yeah, there are a bunch of companies, and I don't want to. I mean, first off, I'll mention a few that come to mind immediately. We love all the companies we work with, and think there are tons of the potential, and it's what makes the job great every day. But we've been investors in Talos for a long time, in the trading technology space. We're incredibly excited there. There's a company called Groma I work very closely. They're the issuer of Groma Coin, which is a tokenized share of their REIT of 2 to 20 unit multifamily buildings. Very interesting on-chain yield product. There, 100 more, but I'll stop there because again, I remember we were coming up on time.
Awesome. And then, like I think we talk about the darlings a lot. What I do want to talk about is the one that got away. Is there like a deal or a couple of deals that have kept you up at night? Like, we've had investors on the show talk about Solana, talk about Pump Fund back in the day. What's that one missed deal
I looked
for
at
you?
Jito pretty early on. And I remember it looked very different at the time. The Solana ecosystem was very early on. So I try and remind myself, like, you're making a lot of assumptions at that moment. So like at that time, you did believe that liquid staking was going to be a big category on Solana, which again, probably I should have, but I wasn't sure of it. I think I was just post FTX too. So it was very hard to convince yourself to do a deal like that. So that's one that comes to mind.
Yeah, I remember my reaction when I saw all my friends get the Jita airdrop. That was a horrible night for me. Uh, Never very good night for them. Like everyone got a six figure. Like I don't know if people remember, but that was when Solana resurgence happened, and we
Yeah.
we can talk about that a lot. That's still like a separate episode altogether. Wyatt, we're coming on time. This has been awesome. I think the last question I have for you, that's probably the most motivating for everyone listening in. Is there one piece of advice that you want to give out to builders who are currently building, might be struggling to raise, or facing hardships in current environment?
Yeah, it's a great question. I think you want to be very receptive to market signals and to what your users are asking for. Like, I think teams that we see that struggle to get early traction and in accompanying fashion struggle to get early funding, they're typically very path dependent to an idea that they really like, and then will build a lot, and then maybe the market reception won't be what you'd hoped. So I would say try and be very responsive to what people are asking for, whoever your user and who your customer is. And you obviously want to know who that is and adapt it based on who has a need. But build something and target a market that's very receptive to what people need and ask for versus prescriptive of something that you're really excited about. And I think that's the hardest thing, is to get away from like what you yourself are excited about and into what other people want and are asking
Yeah.
for.
And I think like with the current day and age of AI, like I think every founder has this sense of urgency as we talked about earlier.
Yeah.
I think the last question, sorry, like
No
this is
problem.
really, I think is the urgency that a founder has with AI in their back pocket as a helping hand, is that urgency real, or is that just in their mind right now? Like when we talk about chasing after an idea, should they be chasing after that one idea, or think about like what they can accomplish overall? I know that's a very theoretical question, but how would
Yeah.
you sort of like Portco?
I think it's somewhere in the middle. I think it's really hard. I think it's really easy to get caught in an echo chamber of things are moving so fast. My business is going to be disintermediated tomorrow, and I have to do this today. At the same time, innovation is happening quickly. So I think you just need to have a sense that when you hit your first milestone, which is an achievable one, that's your point earlier, you are building some kind of moat. So for Groma, who I mentioned, for example, they own the buildings. Like they're an asset manager. Like you can't, the real estate ownership they have doesn't get disintermediated by AI. Like they own a physical asset. And with someone like Talos, they've built a large audience of partners that use the platform to trade digital assets. That is a trust relationship that they've built with users that again can't be disintermediated by software. So I think you want to make sure that you are building towards grabbing or achieving something like that versus a cool product that doesn't have a ton of trust, and in that case it can just be vibe coded and replicated. But if you are building towards something where you have this like stickiness or trust, then their urgency isn't as urgent, which is nice.
That makes sense. I think that sums it up perfectly. I couldn't have asked for a better end to the show. Why, this has been awesome. We covered sort of Castle Island Ventures' key interests. We talked about some of your wins. We talked about the one that got away, Jito, which I thought was really interesting. We talked about AI and how that's changed. This has been awesome. Thank you so much, Wyatt, for the time. I hope everyone listening in, at least if you're pitching the Castle Island, you use this pod as sort of LLM fodder to pitch better. But yeah, thank you so much for the time. Thank you.
Yeah, thanks for having me, Rachit. Appreciate it.
Yeah.